So in our research, what we find is that there is a link between the recent rise in private capital markets and the recent rise in economic inequalities in the US. In particular, what we show is that between 2004 and 2022, the share of investments made into startups by high net worth individuals has actually gone up from 2% to 6% over the period. And we show as well that over this period, like investments in these markets have outperformed in terms of returns public markets. That's how we can link the recent rise and the increasing participation of high net worth individuals in these markets with the recent rise in economic inequalities, because basically these people are earning excess returns relative to public stock markets. And so people that are basically not wealthy are not able to get these returns, and as a consequence, mechanically, economic inequalities go up. There are many different factors one can think have contributed to this increasing participation of wealthy investors in private capital markets. One can think that the tech boom that we have experienced over the past years has contributed. Also, the fact that there have been lower interest rates and potentially investors may have wanted to enter these markets to reach for yield. But in our paper, we particularly focus on the role of tax policy and regulation in explaining this increase. And in particular, what we do is we exploit the expansion of the qualified small business capital gains tax exemption that was introduced during the global financial crisis by the Obama administration, which basically was aimed at incentivizing the participation of retail investors in early stage companies. And what we find is that this expansion actually was very powerful at incentivizing the participation of high net worth individuals in these markets, because basically it imposed substantial tax savings relative to investments in other type of assets, let's say, for instance, public stocks. And so we do see that regulation, and in particular tax policy, can be a powerful tool at incentivizing participation of high net worth individuals in these markets. So the idea of this qualified small business stock exemption basically was that only a few firms, as a subset of firms in the US economy, were able to benefit from this exemption because they had some characteristics. In particular, they had low assets, and they were basically operating in a certain industry or in a certain group of industries. And so what we basically do is to compare the probability of getting financing by these companies that were the ones that basically benefited from the exemption relative to companies that didn't basically qualify for the exemption. And what we find is that after the expansion was introduced, after the tax policy was introduced, the probability of raising financing from these companies that were qualified for the exemption actually increased relative to the probability for the other companies that were not qualified for the exemption. And the intuition is that basically wealthy investors, of course, when they were deciding whether to choose one company or the other, they actually chose the company that was qualified for this exemption, because this way, once they would realize the gains, they would actually benefit from the exemption, while in the other companies that didn't qualify, they could not. So it is very hard to basically say whether this effect is very big or very small relative to other studies, because basically every study has a different approach, and making comparison is not easy. But what we can say is that this return heterogeneity that had been documented in the previous academic papers as being an important force explaining the recent rise in economic inequalities is actually true according to our analysis. And what we show relative to other papers is that these excess returns that wealthy investors can get in these private capital markets that non-wealthy people do not access to are actually a very important force explaining the recent rise in economic inequalities. And just to give you a number, what we find is that if these investors would have instead invested the money that they put in private capital markets, that they put in early stage financing, they would have instead put the money in the public stock market, in particular the NASDAQ 100. Wealth inequality, like the top 0.5% share of the US, would have actually increased by 8% less than they did. And that's why we think that documenting this it's very relevant because it seems to be an important force driving economic inequalities up whenever there are excess returns in these markets. So in our research, what we find is that basically introducing these tax subsidies is actually very powerful at incentivizing investments in these early stage markets. So if policymakers or regulators are interested in basically innovation, boosting basically small business owners and so on, we may want to have these subsidies. What we show in the paper is that there is a cost that comes attached to it, which is an economic inequality effects. And so if we care about these economic inequalities, what we can think about is whether we could increase the access to these markets to non-wealthy investors. But this is, of course, a risky sort of policy because we know that there is a lot of risk involved in this type of markets when it comes to investing. And so one way I think we could think about potentially like improving the access to these markets for non-wealthy investors is potentially by allowing private pension funds to invest a larger share in these markets. And we know that currently private pension funds are quite regulated and the share that they can invest in these type of markets is very limited. So one could potentially think about increasing like the share that they can invest in these markets. And because we know that non-wealthy investors do participate in private pension funds and do have some money in private pension funds, to the extent that there are excess returns in these markets, they could still benefit from the returns. And this way, we could, on the one hand, keep this tax incentive so that wealthy investors can help companies grow. But at the same time, we can also allow non-wealthy investors to also get some money out of these investments, participating via private pension funds. So I think if you ask me after all these years working on this project, the biggest unknown is that we don't know exactly how much money is in these markets. Basically because these markets are not regulated. So there are not official statistics about how much money there is. So we have attempted to come up with some numbers based on some proprietary data that we managed to purchase. But moving forward, I think we need to go in the direction of trying to get a better sense of how big these markets are. Because as of now, we think of our results as a lower bound of the overall effect on inequality, precisely because we are not covering the entire space of the private capital market world. And if you ask me about whether we think that this phenomenon is happening or is going to happen in other parts of the world, so what I would say is that the US is a pioneer in terms of early stage companies and startups. I think the environment is suitable for that. In Europe, for instance, we do see that these markets are developing, but at a much lower pace, And so if we think that Europe is basically going to catch up with the US, to the extent that these excess returns also are going to exist in Europe, then we may also expect this force this excess return channel being also important in Europe. But as of today, I would say that this channel is much more important in the US because the country accounts for half of overall global early stage financing according to our data.